Hey, what's up, guys? I'm only going to do a couple of minutes here and give you a quick financial update on Netflix stock. Netflix is one of the most interesting stocks in the market right now, mainly because Netflix is under attack. You've got a lot of companies coming after Netflix to basically jump into what are being called the streaming wars, where you got Disney. I think everybody from BET to ESPN to Apple are all jumping into the whole streaming business now, and that is leading analysts to wonder if Netflix can hold its own against more seasoned brands. Well, Netflix so far, this quarter, this earnings announcement was a big deal because this was the last announcement that would be made before the streaming wars officially begin. When Disney jumps into this industry, their number one plan is to basically undercut Netflix in price significantly to the point where they're ready to lose billions of dollars to obtain market share. And this has probably put Netflix on edge. The company has a lot of debt, and it's funny because you would think Netflix, with all the money that it makes, they would be getting out of debt, but actually they go deeper into debt to create more content to compete in this evolving industry. So let me jump in and explain some of this to you. I'm in Arizona right now. That's why my background's a little bit different. And so, but I'll go ahead and break this down for you real quick. I'm looking at Market Watch here. It says that basically Netflix beat earnings expectations by gaining 6.77 million new paying customers, but now expects a decline in growth for the fourth quarter and the full year. So they don't expect a decline in size, but they expect a decline in growth. A decline in size is pretty much a death warrant for most stocks, but a decline in growth can pitch your stock price pretty bad. I think that they're trying to prepare the market for what they anticipate to be some serious economic problems in the near future. I think that Netflix is going to have a lot of trouble securing all the financing that they need in order to grow at the rate they probably think they need to grow in order to compete with Disney and these other companies. I'm not a big fan of this idea that you have to fight to be number one. I think it's okay to be number two or number three and kind of stay there, but who knows, maybe I'm the crazy one. But either way though, the stock jumped a lot. It jumped 2% today because they actually exceeded their earnings expectations. They also exceeded the expectations in terms of growth of new subscribers. According to Market Watch, the company had projected 7 million net new subscriber additions worldwide, a healthy jump from 6.1 million in the year ago quarter, and analysts on average projected 6.7 million. The fourth quarter is a different story. However, Netflix projected 7.6 million additions in the fourth quarter, far shy of the 9.6 million Wall Street analysts were expecting, and less than 8.8 million that Netflix reported in the fourth quarter of 2018. So this is what happened in the past. Now, in terms of what happened this week, their earnings expectations, I think they were expected to make. Let me see. I'm looking at the earnings per share here to see if I can find that, because I actually want that to be part of the conversation. Let's see, the subscription growth coupled with strong revenue and earnings sent shares of Netflix up more than 10%. I think it's only up 2 or 3% now, but I know I guess originally it had gone up over 10%, which was a huge jump in a short period of time. The company reported revenue of $5.25 billion, which is 31% higher than a year ago, which is in line with estimates. Earnings per share, however, was $1.47, which was way past the $1.03 that they were supposed to earn according to FactSet. That was the expectation. It did, however, offer Q4 revenue guidance, $5.44 billion, that fell short of FactSet estimates of $5.51 billion. So basically, what they're saying is that when you're talking about a stock price, there are a lot of factors. There are what you expect to happen, and then there's what actually happens. And then also, though, what they're doing now is they're talking about, okay, so what's going to happen in the fourth quarter of 2019? What's that going to look like? And so there's the expectation, and then there's the expectation of the expectation, meaning that the analysts expected, Netflix to come out and say, we expect to earn this much, but instead Netflix came out and said we actually expect to earn that much. So it's sort of like a double negative in a way, if you will, that they expected the expectation to be here, but the expectation actually ended up here. So it's like, I guess, going to your friend's house and saying, well, what time do you expect to be done? And you're expecting them to say 6 o'clock, and they say, no, I'll be done at 7. So your expectation of the expectation was wrong. So what actually has to occur, though, is the final realization for you to really know which expectation was correct, how this new information factors in, how all this works. So long story short, basically, Netflix is basically saying to the market, look, we made more money than we thought we were going to make this quarter. That's a good thing. But they're also saying, hey, next quarter, we expect that we're going to have some trouble because we're going to have Disney popping in here and they're going to be cutting into our money. And I personally think that there's just kind of a flawed philosophy here with a company like a Netflix, because I'm just sitting here wondering, how much can you grow? How far can you grow? And the company, I just really, the idea that they took on all this debt last year, I'm not comfortable with that. At least I definitely know in the Black Business School, when we talk about building businesses, we don't really encourage, at least our people, to create a business that can only survive if you keep getting more and more financing. That's like you're living on top of a bubble that anybody could pop, that a bank could pop, or some bad information can pop. And so I think sustained controlled growth is a little bit more effective and a little sturdier than growth that's built solely on the accumulation of additional debt. But then again, money is cheap, so companies like Netflix are saying, hey, what the hell, let's just go keep borrowing, so we can keep up with the pace of the competition. So it's going to be interesting to see how this evolves. I have no idea what's going to happen here. I don't own Netflix stock. I sold all my Netflix stock. If you want to know what I did, I made a profit. I didn't make more money, obviously, because Netflix kept going up. But I sold it, and I'm okay with selling it. There's nothing about Netflix right now that makes me say, oh, I really want to own that company, because I kind of definitely feel, in fact, I'm 100% sure that if next year, if there is a recession, companies like Netflix are going to take the biggest hit. Companies like Netflix, Uber, these companies that are just built on houses of debt are going to get hit the hardest, and I don't want to be a part of all of that. So that's just my 2 cents, because I think some of these companies are overpriced. So anyway, that's my opinion on it. If you want to learn more about investing and things like that, feel free to join my stock market investing class at theblackstockmarketprogram.com. That's theblackstockmarketprogram.com. Also, don't forget that I'm going to be headed to New York doing a day-long investing seminar with me and you and in a small group, and we're going to form investment clubs and pull people together to form companies and do all kinds of things and teach you how to create an economy in your own house, in your own family. We're really, really good, really, really innovative in our teaching. So feel free to go to drboycenewyork.com. It's October 27th, drboycenewyork.com. And of course, about our social media platform online, blagenough.com. We own this. This is ours. We have to have our own social media to get away from over dependence on the Facebooks and the Twitters to communicate. We got to find other ways to make sure we can always connect. So join us at blagenough.com, drboycenewyork.com, or theblackstockmarketprogram.com if you want to learn stock market investing right now. So take care, guys. Have a good night. I'll see you soon. Peace.